My name is Chelsea Condos. I'm a tax senior manager with Gallagher, Flynn. I'm here to talk to you today about the qualified business income deduction, which is also known as the pass-through entity deduction or the 20% pass-through entity deduction under Section 199A. Section 199A was enacted as part of the Tax Cuts and Jobs Act of 2017. This deduction applies to individuals and some trusts and estates, and applies towards income of sole proprietorships, partnerships, S corporations, rental businesses, REIT income, and some agricultural co-ops. This deduction was enacted in an attempt to equalize the effective tax rate between pass-through and other non-corporate income with the new reduced tax rates under the Tax Cuts and Jobs Act applied to corporations. And this tax deduction is effective for tax years beginning after December 31st, 2017. This deduction only applies for income taxes and does not apply to service businesses with taxable income exceeding certain thresholds. There are two additional limitations that apply to businesses over these income thresholds. The deduction cannot exceed the greater of 50% of the taxpayer's share of W-2 taxable wages, or 25% of the taxpayer's W-2 wages plus 2.5% of the taxpayer's share of unadjusted basis in eligible property. Once we've gotten through these limitations, there is an additional overall limitation that limits to 20% of overall taxable income in excess of capital gains. Next, I'm going to talk a little bit about the steps that Gallagher Flynn will take in analyzing and determining how this applies to your business. Step 1 is to identify whether or not each activity rises to the level of a trade or business under the Internal Revenue Code. This is determined on a separate business-by-business basis. Active versus passive involvement is not necessary for it to be considered a trade or business. The IRS issued guidance providing a safe harbor for certain rental businesses as long as certain conditions are met. However, it did explicitly state that certain personal rentals are excluded from the safe harbor, as well as property rented on a triple net basis. That doesn't mean, however, that these businesses can't still qualify as businesses. It just means that we would have to do further analysis to determine whether or not we could qualify as an active trade or business. Step 2 is to compute the qualified business income. Qualified business income is the ordinary trade or business income. This does not include investment income. It does not include interest income or dividend income. It also doesn't include capital gains. It also does not include income from W-2s or from guaranteed payments. So for example, if you have a partnership from which you receive both ordinary business income and a guaranteed payment, only the ordinary business income is part of the qualified business income eligible for the deduction. Step 3 is to determine the taxpayer's taxable income for the year. If income is above these thresholds, then we have to go through a series of phase-outs and apply other limitations to determine the deduction. Step 4 is to determine if any of the trades or businesses are specified service trades or businesses. The regulations provide a specific list of professional services that includes healthcare, legal, financial services, accounting, consulting, and various other types of services. The revised regulations provide specific examples that actually help you parse out more detail as to what qualifies in each of these categories and what falls outside. Step 5 is to determine whether you are able to or want to aggregate your trades or businesses. There are specific conditions to be met for aggregation, but we won't get into them here. Aggregation can be beneficial when applying the wage and asset limitations. Step 6 is to apply netting rules to lost businesses if not aggregating under Step 5. If there is an overall qualified business loss, then there is no deduction available for the current year, and those losses are carried forward to the following year. Step 7 is to determine the deduction by applying the wage and asset limitations to the 20% deduction. Once we've gotten through steps 1 through 7, we get to our final step, step 8, which is to apply the overall taxable income limitation. The total deduction cannot exceed 20% of taxable income in excess of capital gains. One important note for Vermont taxpayers is that this deduction does not apply in the state of Vermont. These rules are complicated and highly nuanced. As you can see, there are many opportunities for analysis and planning to determine the best position. Please contact us at Gallagher Flynn so we can work with you to determine the best outcomes for you and your business.